I'm Steve Lentz with Discover Options, and welcome to this presentation of a VXX credit spread trading system. If you're interested in an approach that uses the VXX options and gets about an 84% winning percentage, then stay tuned. I think you're going to like what you see. Now, down in the bottom left corner, I think it's from your perspective, bottom left corner, you'll see a little tab there labeled Resources. Go ahead and click there and you can print out the PDF version of this PowerPoint presentation that we're going to go through here, okay? Let's go forward to the disclaimer. Of course, you should always at least one time read through the Options Clearing Corporation brochure on options trading. It has a lot of good information there, and you should know the material in that and also in this disclaimer here that you can print out. What we're going to talk about today is a concept I think first brought about by Larry McMillan in February of this year, 2012, in his newsletter. And then at OptionVue, Len Yates built a few indicators in the software. It's in a package that you can get that kind of tees off on the concepts that Larry McMillan brought forward in February. All right. Now, also, Len describes this approach and in great detail the indicator, the VIX Diff indicator, in the OptionVue's newsletter. So you can go to OptionVue.com, go to the What's New tab at the top, and you can print out a couple a couple newsletters there that really go into this in greater detail. Now, I'm going to cover this in roughly 45 minutes or so, but there's more detailed information in those resources. Okay? Very good. All right. Now, occasionally, I'm going to go ahead and take a sip of either coffee with the SIBO logo that you can see, or water. One of the two. But I am, in the Chicago area, we get kind of some goofy weather, and I'm a youth football coach. I'm outside yelling at the 8th graders quite a bit, and so it does goofy things to the voice. So forgive me if I just take a break occasionally. All right, so in front of you, you have two price charts, SPX at the top and the VIX at the bottom. Go ahead and just take a gander there. And what I want you to notice is generally an inverse relationship. It's general, it isn't precise certainly, but generally as the SPX advances upward, typically the VIX is going to decline. The VIX, once again, is a measurement of the implied volatility of the SPX cash options, a running 30-day volatility number. So if you look carefully, you'll generally see an inverse relationship. When the SPX goes up, the VIX tends to go down and so forth. Now, keeping that in mind, all right, we're going to move forward. I'm going to show you another two charts. Right here, you have the VIX on the top, all right, the measurement of implied volatility on the SPX cash options. And then there are the VIX futures on the bottom. And we're going to progress our way through this to come up with a methodology for trading a derivative of the VIX. It's called the VXX. That's where we're headed. And then I'm going to show you a trading system of credit spreads on the VXX options. So we've got the SPX and the VIX. Now we have the VIX and the VIX futures. See that? Now, I want you to pay attention carefully to the VIX itself on the left. Back in November, do you see how the VIX was, up at about 35 or so? And then you see how it comes down pretty rapidly, down to about, 15, 16 by February. Beginning of February, 15, 17, right around there, and the VIX at the top. Okay, now, look down at the VIX futures. It starts out pretty close to 35, just like the VIX. Now watch this. As the VIX comes down, do the futures come all the way down to 17? No. Now why is that? Why is that? Well, here's the reason. VIX futures, all right, have a delivery date, get this, in the future. That's why they call them futures. It's in the future. And so because volatility, there we go with the voice, because volatility tends to revert to the mean, all right, when the VIX begins to come down to new lows and lower, The futures folks are saying, you know what, in the future, I don't think it's going to stay this low. I think in the future, it's going to revert to its mean and come up. So that's why you see as the VIX gets lower and lower and lower, the VIX futures are looking towards the future saying, it's going to come back and revert back to its mean in time. And so that's a concept we really have to keep in mind here moving forward, is that volatility tends to revert to the mean, revert back to its average. And you can see this in the VIX futures, kind of how the whole philosophy and that whole axiom is played out. Now, the axiom that volatility reverts to the mean, it's kind of messy. All right, it's not, you can't just linearly have it, work that way. Just because VIX made a new low, 20-day low, does it mean it's going to go up? Well, no. But it will eventually revert to the mean, although it might be a little messy along the way. All right, so that's a concept I want you to have as we move forward in building a credit spread system in the VXX. All right, let me go to the next slide here. All right, one moment. Get the logo right. By the way, I want to thank the folks here at the Options Institute for having me on to present this. I hope you find this interesting. I just love this whole notion of volatility and reverting to the mean and building trading systems. It just is, I just love it. What you're looking at now is an options matrix in OptionVue of the VIX options. But most notably, I want you to see the line labeled futures. Do you see that? And in particular, I'm going to go ahead and circle the prices for each of those futures. And I want you to note how the front month future is priced much lower than the next month future. See that? This is a pricing structure that we're going to label normal. All right? When the market is going up, the VIX is typically coming down, okay? And there's an expectation that in the future, the VIX will revert back to its mean by going up again. So the distant futures months will be priced higher than the front month, and so forth. You'll see this pricing structure played out. We're going to label it normal. Now, watch this. If the market were to go down all of a sudden and the VIX goes up, there would be an expectation that in the future the VIX would come down, and then you'll have a backwards situation where the front month will be priced much higher than the second month. You see that? Okay? So we're looking at this relationship of the VIX futures. And we're going to actually take measurements of this. And this is what becomes real interesting. So here I'm going to take the information you just saw. I feel like we need almost a little break for water. For water or a joke or something, because we're just going on progressing through here. But I'm showing you now the 4 futures months in the VIX futures. You see that? Notice how the front month, X2, and Z2 is the second month. You see that pricing structure there? How the second month is priced 85 cents more than the front month, okay? That's the relationship we're very interested in, is those front 2 months in the VIX futures. And we're going to measure that, and we're going to graph it, and we're going to do all kinds of fun things to it, all right, and derive an actual indicator from it. Okay, Alan's asking, at any time there will be several months of futures. Is there a graph? Is this graph a blend of the several months or just the nearest month? The graph. That graph of the VIX futures, good question, was a running 60-day forward contract, and that was derived in OptionVue, a running 60-day forward contract. In that particular case. Now, you can get continuous contracts, and just depends on which vendor you're using. But in OptionVue, good question, 60-day forward contract in that case. Okay, now we're dealing with the front 2 months here. What we're going to do is measure that, and what we're going to do is take the second month minus the first month. Second month minus the first. And in a normal pricing structure, there will be a positive relationship there. The number will be positive. All right, in this case it's 85 cents. Now what we're doing in OptionVue in our little package of VIX tools, the VXX trading tools, is we're going to take that difference and add it to the number 10 and then graph it. We can't do 0 and graph it because in price charts, it has to be a positive number. And so we just said, okay, 10 is the baseline, all right, and anything above that is a positive, anything under that would theoretically then be a negative relationship. So here you can see the relationship is 85 points. And you could see down at the bottom the VIX Diff, $VX DIF. That is a symbol unique to the folks at OptionVue. We've created this indicator. It's available to the subscribers of OptionVue and those that have purchased the software. And it's available in a package. You can call the office and find out all about it. It's pretty cool. All right. You can see that the value is 10.85. All right. And then if you look at the change number, the base is always 10, you can see it's plus 0.85. So every day, whatever the difference is, that's the change value is always from 10. Okay, so VIX Diff, all right, if the two are even, second month minus the first is 0, you're going to have a value of 10. 10 is the baseline. Okie dokie? All right. Moving forward, here is a graph of the VIX Diff. Every day, that difference is plotted. Even the intraday bars are plotted here, with 10 being the baseline. See that? All right, and I took it to the beginning of November or so. What I want you to really notice, interestingly, is, well, I'll get to that in a second, okay? Mine's going forward, too much coffee. Let me switch to water here. All right, look at the VIX Diff. What we're going to do now is take a moving average of this. Remember, we're building an indicator, moving our way towards a VXX credit spread system. That's where we're headed. Using this as an indicator. Now, we're going to plot a 15-day simple moving average on the VIX Diff, and we have 10 as the baseline. You see that? Kind of the baseline there. I want you to notice when the moving average crossed from beneath 10 to above 10, when was that? Look at that, back in late November of 2011. It's been positive ever since. And if you read Len Yates' article that I mentioned, he goes into a complete trading system using this as well as another indicator, after yours truly, in a complete trading system for the underlying ETN, the VXX. Now, what we're doing today is a credit spread system using the options. Okay, so but interestingly, look at that when that crossed over, and if you look at the timing of that, it was just perfect timing for the beginning of a bullish market at that point in the broad market. You see that? Okay, so since then we've had a positive or normal pricing structure. What we can do now is create the indicator, and this is as it would appear in OptionVue if you were to do this, if you were to have this. And my indicator, the Lentz volatility indicator, are the little green bars. We're not looking at those today. It's perhaps for another time. But look over on the left when it crossed above 0 there, or 10 if you're using the price charts. That was an indication to basically go short the VXX or long the broad market if you wanted to trade it that way. So that's what the indicator looks like, and we're going to really tee off on this because when the indicator is positive or above 0 in this case, that's when we're going to do bearish trades in the VXX. What to trade? Okay, I already gave it away. The VXX. One moment here while you take a look at this. Look at late November back in 2011. Look at that. Pretty cool how the VIX futures were really signaling a good time to maybe go short the VXX. Okay, by the way, if you're interested in going long another ETN, the XIV is an inverse. You would go long the XIV, or you could go short the VXX, but the XIV doesn't trade options. VXX does, and that's why we're so interested in this, okay? Look at the timing on late November. Doesn't get much better than that, folks. Now look at this thing. What is the VXX? It's a Barclays Volatility Exchange Traded Note, ETN, that owns the front 2 months VIX futures in a proper ratio to simulate a 30-day contract. Okay, once again, all right, it's an ETN. It owns the front 2 months VIX futures in proper ratio to simulate a 30-day contract. So what's happening? Every day, all right, the ETN has to move contracts out from the front to the next month. So it's going to always sell the front and buy the next month futures to simulate that 30-day constant 30-day contract. So it's constantly reinvesting in the forward in the second month, getting rid of the front, moving slowly over to the second, selling the front, buying the second. So watch this. If the second month is priced higher than the first, okay, you're selling the front, buying the second. Do you see how it's a drag on the ETN? It's a slump. It's a daily. It's a small drag on the ETN from going up. It's a net debit. All right, and theoretically, I mean, it could just keep going down and down and down and down with those little bit increment as it rolls at a net debit if the pricing structure stays normal. And indeed, you can see since November, when we adjust for the splits, and it recently had a 1-for-4 split, this thing has split quite a bit over time. Look at how dramatically it can move. Wild, 180. You know, down to in the 30s right now. All right, lots of room for bearish activity right there. And that's why we're so interested in doing call spreads when we have the right pricing structure. It's because you have a built-in little, mechanism that's a drag on the thing from going up. Likewise, when we're bullish, well, I'll get to that in a sec. Okay, so that's what it is. Now, the VXX trades options. About 9 million a day are trading. It's been higher than that. I think about 6 months ago it was like at 18 or something. It's come down to about 9 million a day in options on the VXX. Very liquid. So this is why we're interested in these particular options. Now let's take the VXX and let's put the VIX Diff indicator underneath there. One moment here while you take a look. All right, you can see when the VIX Diff is positive, that's a bearish condition, as we just described. And what we would do in those periods is pretty much just do call spreads, sell call spreads on the VXX. When the when the VIX Diff is negative, that's when we would look at bullish trades in the VXX and so forth. Going way back. Got that? All right, you see where we're headed, right? We're headed towards building a trading model. Now, you could just, I want to present the notion of trying to time this better. You don't want to just do rolling call spreads. I'm going to propose to you that we try and time it a little bit better using a few technical indicators. Now, many of you guys watching, I know, are technical analysis aficionados. I mean, you know a lot about technical analysis. And given this information with the bullish and bearish conditions, I would go ahead and suggest you can build your own model if you want. I'm going to throw one out there that, works pretty well. But this is the beginning point, is the VIX Diff indicator giving us a general feel for which way to go on the VXX. So here are the rules. Let's just start with the bearish, because that's kind of, certainly the majority of the time that's where you're going to be, given the pricing structure. And we'll just invert these. But basically, when we're going to go bearish on the VXX through credit, bear call spreads, we want the VIX Diff to be positive. All right, just explain that. And the VIX Diff is, say, going down, or excuse me, the VXX is declining. We're going to wait for a retracement. We're going to wait for it to come back up and then roll over again for a small recovery, and then boom, when it reverts back on its downward path, well, then that's when we'll sell some call spreads, okay? So you can see there the stochastic 511. We want it to rise to 50 or more. That's indicative of, you know, it's coming down and now we have a little retracement. Then the trigger is going to be when the price goes down below a 2-day low, and we want the VXX to be below its 20-day exponential moving average. If that happens, we'll go ahead and enter at the close and put on a bear call spread at that point, okay? All right. How do we put on our credit spread? Well, we're going to go with the first month with over 21 days remaining in the VXX. And we're going to put our short strike just beyond that pivot point up above. Remember, it's coming down, you know, like this, all right, like a rabbit. All right, coming down. It goes up, curls over, going down below the 2-day low, and then we're going to put our short strike right there, all right, right above that most recent high. Isolated high right there, okay? See that? And if price goes up and hits that short strike, we're out. Okay? If it continues down like it should, well, then we'll go ahead and let it go to expiration, you know, and just take the whole thing and let it expire worthless. Now that's a baseline. This is a baseline study for you, okay? Clearly, if the thing blasts down and you make most of your money in a few days, well, then take it off, okay? But I'm just going to present to you the baseline results just to kind of see if this thing has any merit or not, okay? So that's kind of where we're headed. Let's see, anything else? No, we exit on it, hitting the short strike. It'll expire worthless. Okie dokie. Let's go and take a look at a few examples. Now let's see. All right, so here we have, I just want to show you the span of the study that I did. Went from August of 2011, so I would get in that bullish period, and then over to the period where we're bearish from, you know, late November onward. Okay, so that's the span of the study that I did, seeing how this worked. Here are the stochastics. 511, this measures the retracement, and then we wait for it to roll over, and then we're in. So that's, you know, if you want to do this, this is kind of what you're looking at. Is a moving average of 20 exponential and then a stochastic of 511, all right? All right. And here, you know, I wish I'd put the dates for the bullish. You'll see those in a second. I just labeled some of the dates on the right. And those are the bearish trades on the right that I labeled. The bullish trades on the left. You know, I'm on the train coming in here, and I go, why didn't I put the dates for the bullish over there? I don't know. You'll see them in a second, though. But we're going to take just a few examples from the bearish on the right. And what we're going to do is, on the baseline study, we're going to go ahead and take every signal. Even though we have a trade on, if there's another signal that happens, we'll take that one too. And just see how well all the signals did. Okie dokie, all right? All right, let me get another sip before we go to the next slide. Two examples. All right. 12.9. This was the first one that was bearish. Do you see 12.9? Do you see how it drops below the moving average and then stochastics comes on up over 50 right there, and then boom, in one day it takes out the 2-day low and we're in at the close. See that? Where would we put our short strike of our bear call spread? We're going to put it at around 45, just beyond that little, you know, pivot point that you see there, just the previous bar. And we're going to challenge the market to then go up and hit 45. Given the VIX Diff structure, given the trend, we're going to go ahead and think that that's a pretty good high probability trade. Now here we go, we're putting it out at 45, and you can see we're selling the 45 call, buying the 47. I'm throwing in about $1 commissions in this particular study for each contract, you know, trying to keep it real world. Graphic analysis, Pretty, I think you guys kind of know how to read these, right? You can kind of see it's 3 time frames. The x-axis is the price of the VXX. The y-axis is the profit or loss. 3 time frames. Today, expiration is the straight line, and then the in-between is the dashed line there. Kind of tell if this thing were to go to the right and move up and take out that 45 number, it looks like we could lose maybe, well, it looks like we're probably risking 1 unit to make 2, something like that. Maybe a little, maybe not quite that, but pretty darn close. You can kind of tell if the price went up to the right, we would lose roughly 16-17%. If it goes down, goes to expiration, we would make 32%. So this is what we're looking at, is a good reward to risk ratio, and you're really using good market analysis, blending it with a pretty good option spread here. In this case, that made money, obviously, right? I mean, clearly price went down, and that would have expired worthless. That particular trade made money. Now, let's look at one that didn't make money. And this is why you should consider, doing a yield grab. All right, here we have another one. Price comes, moving average is right there. Stochastics comes up over 50. It rolls over, takes out the 2-day low and closes beneath the moving average. We enter short. We sell premium at about a 21 or so. And for the next 2-3 weeks, most of the money's on the, profit is right there for us to take. Look at though, price came up, and just before expiration, all right, it takes out our short strike over there before those March options, or excuse me, before those May options expire. It goes down in the books as a loss. However, on a yield grab, which I think most of us would have done, we would have probably taken off the trade, when we had, 80-90% of the profit sitting on the table. Maybe not. Depends how you trade. But in this case, we're going to stick to the rules, and we would report the loss. So here's what it looked like at the beginning. Selling the 21 premium. See that? And that's what it looks like. A little bit better than a 1-to-1 reward to risk ratio. We're risking 1 unit to make about 1 and 1.2, something like that. And so indeed it went up and hit that 21 mark right there. And that would have been a loss right there. Now clearly, it would have been, we would have had most of our money profit sitting there, but we're going to stick to the rules, and I'm going to report to you how well the whole approach did. Any other questions along the way? If you have questions, go ahead and fire away. It takes about, 15 seconds to get in here, something like that. So that's fine. Go ahead and fire some questions if you have them. I'll do my best.
Yeah, I didn't have any.
The results. All right, now, listen, I'm using OptionVue's BackTrader here. This isn't a real account. I want to make that clear. These are hypotheticals using OptionVue's BackTrader module. OptionVue has saved option prices every 30 minutes of the trading day on ETFs, indices, stocks, futures, going all the way back to January of 2001. 2001. So if you want to do back testing on any of your approaches, you can take it through the rigors of 9/11. Summer of 2002 was pretty rough. 2008. All right, all through that, you can shock test your approach using the BackTrader module. So if you're interested at all in doing that with data going back that far, this is something you definitely want to look at and give our office a call. All right, so here we go. Here are the results going back to August of 2011. Most of them are winners. And you can see there are 3 losers in a row there. And we're going to talk about that in a second. But you could see at the beginning, up at the top, we were bullish, the VXX, so we were doing put spreads during the bullish time, right? And then when it inverted and went over and became a normal pricing structure, we would then sell call spreads. and everything's going fine, and then we ran into that period there where just one market move back in spring of 2012, spring of this year, because we took every signal, 3 in a row on that one market move were taken out right there. Okay, but other than that one market move where we took every signal, though 3 times in a row, you could see it has pretty darn good results. Now, if you wanted to do this and not take every signal, but just take the ones that are there when you don't have a trade on, I went through this. Roughly, you're going to put on about half the trades. In this case, it would have reduced the number of, it would have been about 9 and 1. You would have won 9, lost on one of these, had you just been in on one signal and not taken the rest, okay, while you have that initial position on. So if you take everything, here are the results you got, you know, from August 11 through last month. 25 trades, 21 winners, 4 losers. The average winning trade, 234, average losing trade, 298. We're doing 10 lots here, okay, on the VXX with dollar commissions. And not too bad. Clearly a trading edge. Now, again, as I said, if you just wanted to take one signal at a time and not take those that are going on while you have a position on, now you're cutting it down to about 10, 11 trades with one loser. But you can go through the data yourself right here and cross off the ones that occurred while you had a position on and kind of see for yourself there. Okay? But this is just one approach. Okay? I think you can appreciate that the VIX Diff relationship in the VIX futures sets it up. All right, the bearish condition, the bullish condition, and now you can kind of try and time your way into this thing. Of course, you know, you could just wait for the next signal when the moving average crosses 0. Doesn't happen that often, though. Doesn't happen that often. And so if you want to get in and do other stuff, you're going to have to come up with a timing mechanism like we described, okay? All right, anything else? No. That's it. So I'm hoping you have some questions, as my voice gets raspier and raspier with this cold Chicago air. And, oh good, a question's coming. You got in on technicals, why not exit the same way? Why not exit the same way? Well, you certainly could. Absolutely. I always like to get on the entry and pretty much challenge the market to then go ahead and defy the trend and go back the other way and go beyond a certain support or resistance point. In this case, you know, we are using, I guess you could say we are using technicals to exit because we place the short strike. In this case on the bearish, we're placing it above a resistance level. So if the market does come up, take out that resistance and hit our short strike, well, it makes sense you would get out because it took out a resistance level and is showing the trend to be the other direction at that point. So in that sense, we kind of are. You can, you know, if you're into this at all with technical analysis, you know, there's just a myriad of ways that you can go ahead and get out, and certainly I'm open to that. I'm also open to maybe finding a way to filter out those 3 losers. All right? One way is to simply not take a trade every single signal, but to stay in on every one signal. That would remove a lot of these losers. That's another way to do it. But clearly, obviously, absolutely, if you have a way you want to exit on technicals, I'm certainly open to that. But I presented here just a simple baseline just to see if the whole notion has any validity, and I think it clearly does, in using the VIX pricing structure as an indicator of the direction of the VXX. Oh, yeah, Charles, we're using just the monthly options. Didn't go to the weeklies here. Didn't go to the weeklies. We're just using the monthlies in this particular case. And we're going out to the first month with over 21 days. That's when we put our credit spread on. First month with over 21 days. Why stochastics of 511? Well, what you want to do is have a decent measure of retracement. So if the VXX is coming down and it retraces up, you need some kind of way to measure whether it's a reasonable retracement or not. All right, and there's a number of ways to do it. I think using stochastics of 511 is a good short-term measure of retracement levels. All right, it's obviously 5 trading days in a week, etc. So over the last week, the stochastics has risen, and that's a good time to consider that that's a good retracement level at that point. You can alter it, certainly, feel free. You can use other indicators to navigate the notion of a retracement. 2-period RSI, there's a huge catalog of indicators to measure a retracement, but I've always liked the 511 as a period, as a good indicator of reasonable retracement levels. All right. Anything else there?
Oh, sorry. There are.
What else is a good retracement? I like that one. What else? RSI, 2-period RSI is good. But when you start comparing them, you'll see that the 511 and the RSI2 kind of coincide quite a bit sometimes. You can pick one. You don't need to use both. You can also, want price to take out a 3-day high. That might be interesting. You can demand that. That might be a little too much. Maybe a 2-day high gets taken out, exceeded, and then look for it to roll over. That might be one way to go. But you get the picture, though. Trending down, retracement, rolls over, sell the premium right there. You like that? All right. Trending down, retraces, curls over, sell the premium right there. All right.
There should be another one right there.
UVXY. If it works for VXX, why not UVXY 2 times? VXX has much higher vol than UVXY. I don't have an answer for you. I have not explored the UVXY. I'll be honest, the 2 times ETFs or ETNs, I'm a little gun shy on doing that, because here's the deal. You want to try and keep things as close to an underlying as you possibly can. And when you get into the realm of VIX futures, VIX options, implied volatility of the VIX, you start getting several times removed from something tangible, and then you throw in a 2 times in there. Trading's difficult enough. You could certainly try it on the 2 times, the UVXY. I haven't explored that myself. I'm just going to be honest. I'll take a look at it at the office, the UVXY for sure. Michael Jackson. Where we have slippage. In this test, I didn't have slippage included. I went with those because, when it trades over between 9 and 20 million in options, I did not include slippage in this particular one. Okay, that's the question here. Okay, now a question about my personal trading. I am a non-directional guy in the ETFs, to be honest. This is something we promote to our students that like the VXX and like trading this way. I like to trade in the way we trade our level 3 strategies using butterflies, condors. That's what I do personally. I'm going to be honest. Our mentors all trade that way. Now, we have a few guys in the office that trade this way on the VXX. And if you call and talk to them, they'll be glad to talk to you about their experience. And as a researcher, I do a lot of different systems like this, but I personally like the level 3 stuff we do in our mentoring program on the indices with butterflies, condors in a campaign style approach. And yes, slippage is an issue. Slippage is an issue, and you want to pay attention to that. I favor assets that have options with low slippage. Spider's a good one, and if you trade the SPX, please use limit orders, okay? And that'll save you a lot instead of the markets. Why not use larger spreads? 3-4 points are the liquidity or order filling issues. You could use larger spreads. Okay, I'm just giving you a baseline set here to determine the legitimacy of it. You could certainly use larger spreads. You'd have to reduce the lot size, of course. Okay, no problem with that. That's a question here. Okay, and liquidity on the VXX when it trades $9 to $20 million a day, no, there's not going to be liquidity issues there. Not on that. Thanks, George.
That is all we have for today.
All right. Folks, as I mentioned, let me go over here. Boop, boop, boop. Okay. At Discover Options, we teach several different approaches to trading, most notably the non-directional stuff that our own mentors use to manage money themselves, for themselves and that of others as well. So we teach consistent stuff with what our mentors are trading themselves. And so if you're at all interested in that, give us a call. We'd love to hear from you. Thanks for joining us. A lot more on the website. Thanks to the folks at the Options Institute. I sure appreciate you guys. Thanks so much. Bye-bye.